Hello and welcome to Invest with Rules Update. I'm Scott Bennett here with Mike Olafson. Today we have a lot to go over. We are going to go over a little bit of how the sausage is made with the Billion Dollar Fund Manager report. We're going to go over a concept called VOMO, Volatility Adjusted Momentum. We are working diligently on the Billion Dollar Fund Manager report. So we're excited. We have a lot to cover, and let's jump into all of that and then some today. Here we go. So Mike, so here's what we're going to cover today. We had some Q&A on the Billion Dollar Fund Manager grades, the A, B, and C, looking at grades versus rank. We're going to cover VOMO. We're going to cover market trends. Before we do world's quickest disclosure, per the usual, this is just information, not a direct solicitation to go buy or sell anything. Please always manage your risk, manage your financial plan. You know the dance. So, Mike, so what we've moved towards over the past, call it a year or so, are these grades. And maybe, Mike, you could kick us off a little bit with just kind of what our thinking is around the grades versus a ranking system. And you'll see this is the report from this month. You'll see some of the top performers this month happen to be B's and C's versus A's. So maybe just a little bit of context, Mike, if you don't mind starting us there.
Yeah, when we started implementing the grades back, what was it, about 9 months ago or so, Scott, it felt good to differentiate, and that's really why we did it, to differentiate different groups in the billion-dollar fund managers. So if you had an investment choice of two different stocks and one was an A and one was a C, you'd probably go with the A. But the scoring itself was somewhat the way we got to the ABC was somewhat kind of, it was a conglomeration of different factors in our analysis. And it really didn't prove to be all that meaningful when we looked at ultimate performance and back testing, or just pretty much example you have up on the screen right now, which is why we decided for November to do it a different way, which we'll talk about over the next several minutes.
Let's do it. So, first things first, let's go here. So, today we have A, B, and C, which are helpful, but the reality is could it be better? And we're always a little bit about small tinkering to politely help us, help our families, help you. We really, truly want to help us all get better results. So, moving more from a grading system to more of a ranking system. So, let's go behind the curtain a little bit. So, the first things first is we have this. I'm a pretty linear human when I learn. So we have this huge list of what the funds are buying. So whether they're buying, selling, or holding, this is kind of the pre-existing list of stocks. And this is what the billion-dollar fund managers are after. That's kind of phase one. Phase two is liquidity. We want to invest in things that have a certain market capitalization size, so much so that we don't want to wake up and it's constantly moving 10+% every single day. That's a lot to handle for most people. The next is we want to then filter that list. So think of it kind of like a funnel. So maybe we'll knock out just like one or two names that maybe are just teeny positions in their database. Then we're going for fund buying. So we really want to see no matter what holding, but we really want to see fund accumulation. Then we're looking for earnings growth because if you think about it, we if level one is predominantly the S&P 500 and the Nasdaq and small caps, you're going to get a broad exposure of these top holdings. But we're really looking for in level three, the billion-dollar fund manager stocks follow big money. We're looking for things that are really interesting and growing pretty fast. And then that leads us to VOMO. Mike, anything you'd add here on this slide?
Yeah, I'll throw out two quick comments. You used the word funnel, and that really what is exactly what this is. Roughly speaking, you start off with a group of X all the way to the left with the massive list, and then by the time you get to the right, you're probably around 10% of that original list, give or take, when you kind of go through all these different stage gates. The second thing I'll mention is, and this is something, Scott, that you've kind of opened my eyes to, where earnings growth is not just necessarily, I automatically think of earnings growth at that high flying IPO that's doubling sales and doubling earnings. But no, it could be a turnaround play. A company that was, say, had very meager profitability all of a sudden accelerates due to a new product or innovation or whatever the case may be. So I think it's important to know that earnings growth isn't just simply going for those IPO kind of like jet setting names.
Yeah, good point. And we'll hit that as well. So So Mike, why don't you cover this slide and I'll cover the next one.
Yeah, so everything we do with trading, investing, what we're trying to achieve is gains in stocks. We buy something to hopefully we buy it at X to sell it at Y and make money. That difference is in X and Y is called momentum. It's basically, how is that stock tracking? And what is momentum? Momentum is really motion. And in order, when something is at a stagnant state and gets kickstarted, like this graphic shows, take that soccer ball. If you get a kick, a force applied to it, it will start rolling. And once the momentum kicks in, it will typically continue to roll. And until something stops it, a bump or whatever the case in the case of a soccer ball. But the bottom line is momentum is really the name of the game, is the foundation of everything we do, whether we realize it or not, of stock investing and trading.
Love it. So when we think about momentum, one thing that we also want to apply is volatility adjusted momentum. So at the top, we have Boston Scientific, BSX, and at the bottom, we have Tesla. And very simply, they both kind of relatively look, to some extent, lower left to upper right. But if you think about just what we're trying to do is a ranking system, volatility adjusted momentum. We want things that are moving in the right direction, but we also want things that are a little less choppy, that are a little smoother. We want, and we'll rank that at the end of the funnel line for, I mean, it's really hard to hold incredibly volatile stocks where it is relatively easy. And our goal is to own great companies and politely sit on them and just let the compounding happen. So I want to share that with you. And before anything else, Mike?
Yeah, good analogy. And we use obviously with our gas, coast, brake, we use car analogies a lot. A good analogy here is, I live close to the Pennsylvania Turnpike. If I'm going from Philadelphia to Pittsburgh, a 5-hour trip, would I rather jump on the turnpike, set the cruise control, and then just fly? Or would I rather get caught in traffic, have to speed up to make up for the traffic, slow down with more traffic, speed up? What would I rather do? I may get to Pittsburgh in 5 hours in both methods, but the cruise control method, the low volatility method, is going to be a lot less stressful to me.
Yeah, that's a good analogy. So innately, on the left-hand side is the S&P 500 holdings year to date, who's performed the best. And on the right is the Russell 2000 based upon year to date, who's performed the best. And innately, what we all really want at Invest with Rules is we want to own the cream of the crop. So we want to own great things. We would then filter this for what the funds are innately what the funds are buying. And then we're also looking at things that we really don't want. So we had this real life scenario where one of our clients handed us NVIDIA and Supermicro, and Supermicro's having just a miserable day today. We don't own it. We sold it a long time ago based upon our trend roadmap process. But if you look at Supermicro, that was like the cream of the crop at the end of 2023. And it started the year like on a rocket ship in 2024. And you'll see what happened since March. This is split adjusted now. It's gone from 120 to 34 bucks. So this is what we don't want. You don't want to just blindly buy the best stocks in the market because they can crumble on you. And this is the one of the things that it's unacceptable. And we know that you don't want it, we don't want it. So we have to have mechanisms and processes, and we already do, but we're just kind of sharing innately what we want and what we don't want. So Mike, maybe you could hit a little bit on absolute versus relative momentum and how that applies to the small little tinkering that we're doing.
Yep. And kind of like how we kicked this segment off, we talked about what momentum is, that rate of change. Well, really, momentum, generally speaking, gets broken down into two buckets when you take it down to the next level: absolute and relative. We as members, as you know, as a member, we rely a lot on RSI, relative strength index. That's absolute. Relative could be like Investors Business Daily RS, relative strength rating, or in our case, our VOMO. So let me give an analogy to explain the difference. So let's say, kind of continuing a car analogy, we are race car drivers and we're doing laps in our race car. So we do a lap, and that lap is, say, 2 minutes, just for the sake of argument. Well, are we comparing ourselves To the rest of the 100 competitors in that race, that's relative. So how does our 2 minutes compare to everybody else, the other 100 racers? Absolute is how my 2 minute lap compares to how I've done. If my normal lap is a minute 50 seconds and I do 2 minutes, that's not too good. I'm lagging. If I do better than 2 minutes, I'm doing better relative to myself, not everybody else. That's the difference between absolute and relative. They both have a home in our process. RSI is kind of a mainstay in our foundation, but the relative momentum is where we're going to differentiate the billion-dollar fund manager stocks. And and when you take the rate of change and then you factor in the volatility, that's what gets us to VOMO. And quite simply, without getting too kind of into the weeds here, we take momentum and we smooth it out with volatility ATR. That's average true range. I'm sure you all have heard us talk about that several times. It's basically how a stock moves on any given day, up or down. And we turn into a percentage. We factor it into the rate of change, momentum, relative momentum, which gives us our calculation for VOMO. Not going to go into the nitty-gritty mathematics of it, but the bottom line is VOMO is that expression for us of momentum that smooths it out for volatility. Scott, did that make sense, or anything you want to add to that?
No, it makes a ton of sense. So we kind of got to the line. So we have the big funnel list. We strip out some of these micro cap companies that are like, think like hypothetically like $100 million company that huge funds, maybe like one fund can get in, but most funds really can't get in and out quickly with capital. So we have this little tiny squeeze of get the funds out that are companies that are super small. We want the funds, the stock that they're buying. We want earnings growth that are consistent and large. Then we're looking for this VOMO, which then lets us rank. That's the ranking methodology. And then finally, we bring it through to our trend roadmap, which is saying the timing. We innately we can buy stage ones at kind of half positions if one so wanted to. We're really going after these stage two advancing phases. So we're going through this massive funnel, and then that gets us to we want to own the cream of the crop at the best possible or optimal time. And that's a gas signal, a short-term and a long-term uptrend. As well, it's not innately overbought, meaning that it's gone up so much without you, and then you just buy it and it falls on your face. So we're looking for this. This is how the sausage is made. And very simply, we just made a teeny tiny tinker to the end of the funnel is what we've done. So speaking of trend roadmap, I'm going to stop there. Mike, any final comments before we dive into the live sheet? Because the fund manager report, the $1 billion fund manager report for November, it's kind of funny, we're in November. It's coming to a theater near you very soon, in theory, most likely tomorrow. So tomorrow's the last day of the month. We're almost ready. So that's what's going on. So any final comments on VOMO and where we're heading?
Yeah, and I guess the one key thing just to kind of underline is because now we're going to rank what you're going to know as a member now, and what we, Scott and I, will know when we are making our decisions is if you've got an investment choice and the trend roadmap says that that two stocks, $2 billion fund manager stocks are on gases and one is ranked 10 and the other is ranked 15, you know that the number 10 one has done better over the time frame we're analyzing than the number 15. Does that necessarily mean that it's going to do better going forward? We don't know. Nobody knows. But this goes back to momentum, where the historical analysis and backtesting shows that something in motion, a trend going on, tends to continue unless something stops it, which is why we think this VOMO is so important. But just want to underline, kind of, that's the ranking. So it's a lot more pertinent than the old ABC that we've been using. So
Yeah, and I think just really simply, in our level 3 portfolio, we want to own names that are on our list, that we have a great list. It's just how at the back end, are we selecting the cream of the crop? And that's kind of the question that we ask ourselves plainly every day is, like, this past month of October, it's like Reddit and it's Carvana, and they are rocket ships. And we want that exposure for ourselves, for our family, and to do really well. So you can innately be a successful member in our system. And again, here's our $1 billion fund manager report. We're going to soon say goodbye to October. We're heading to November. We'd love to not only have a great list, but we'd like to be picking great stocks off of that great list. That is the joy and the focus of Invest with Rules. And mainly, we're trying to follow trends. That is our mission. We follow big money. We follow risk management rules. If you have questions, if you're like, this makes sense, or can you go deeper, or you have a video idea for us, shoot us an email. It's hello@investwithrules.com. If you're sitting there and you're like, this is so cool, but I don't have the time, or I'm missing signals and this sounds great, I'm just too busy at the moment, just shoot us a note, hello@iwradvisors.com. We do this for clients. We help clients with this in an advisory position, along with kind of deep financial planning. We really care about you and your situation. Thank you again. We'll see you soon.
Thanks. Happy investing.